Hey everybody, it is John Lone King. It is Friday, the 17th of July. Thank you for joining me today for my weekly update. There is not a lot of news on the interest rate front. It seems like we just keep dodging bullets or maybe having bullets fired at us. I'm not sure how to phrase that, but if it's not one thing, it's another. So we've got a lot of things going on in the geopolitical market right now with Iran and with oil prices. We've been talking about that forever. And now we're looking at the Fed obviously saying, hey, we think we're going to raise interest rates. We've been talking about that. No change there. Good news this week is inflation has come down some. So statistically, inflation isn't as bad as it was. That's misleading because it basically says, hey, prices went up a lot last year. And now they're only up a little bit more compared to that. But that is part of what inflation is how much more did it raise over what it went up before. So that's a good sign. It's probably our only good sign, other than there's some issues going on in the stock market right now. That is showing some weakness in the economy. It could be short term, but it often will lead to better interest rates. Now, not big differences in interest rates, but minor differences from day to day. Typically, when there's bad news in the stock market, it's good news for rates because investors pull their money out of the stock market, put their money into the rate market. But here's the deal, it's volatile every day. And so unless you have some crystal ball to know exactly where rates are going to be tomorrow, if you're in contract, lock your interest rate because you're going to see some new news that comes out that's going to sway rates one way or another that was unexpected. You're never going to win that battle. So when it comes to interest rates, we're kind of stuck in the sixes for the time being. I do expect at some point we're going to move into the fives, but at this point, it doesn't look like we're going to make that happen anytime this year. And who knows how far beyond that it's going to take. So we're in the mid to high sixes right now. We could theoretically come back down into the low sixes, but that's all just luck of timing. We need to be making decisions about strategy, about what is the right move for you. And so a couple of things I want to talk about today. First of all, is I want to talk about some alternative lending scenarios. There is a whole world. Now, this world has an industry term called non-QM or non-qualified mortgages. Now, a lot of people think, oh my gosh, Sean, that once you describe it, that sounds like it's the subprime loans of 25 years ago. It's not, but it looks at common sense to a degree. It looks at, focuses on a couple of particular areas. One area is people who are self-employed. That, there's a disincentive to show a lot of profit. Even though you might make a lot of profit, you want to find a good CPA who minimizes the profit that you are showing because you have a partner in your business, whether you want it or not. And that partner's name is Uncle Sam. You have to pay a portion of your profits to Uncle Sam in the form of taxes. If you can legally show less profit, that's good because you pay your partner less money. But the mortgage world's always looked at, well, what do you show in profit to the IRS? Because mortgages typically came from the government. And the government says, I'm not going to let you qualify based upon income that you're not paying us taxes on. But the banking world, the non-qualified mortgage world says, well, common sense says if they're depositing the money, then they've got the cash flow to make this work. And so bank statement loans allow us to look at that and look at the reality of how you're receiving your income as a business owner. Another example is someone who wants to take out a loan on an investment property. Well, if you're taking out a loan on an investment property and the income from that property more than pays the payment on that property, that used to never matter. It used to be, yeah, but we got to look at everything in totality. And then these non-qualified mortgages came out a few years ago and they said, well, no, let's look at common sense. If that property's income pays for that property's debt, as long as your credit's good and you have some extra cash in the bank, you're golden. So that's called a debt service coverage ratio or DSCR loan. Those are some examples of common sense in the mortgage world that's come out. And I haven't spent a lot of time talking about these things, but I want to share them most importantly because at Cross Country Mortgage, where I just came 4 months ago, Summit Funding merged with Cross Country Mortgage. Cross Country Mortgage is the largest mortgage company in the nation from retail lending, the loan officers lending the money directly. That opens up more channels than what I've ever had. What I mean by that or how that matters to you is we actually take non-QM loans and go significantly further. And I'm going to quickly show you what this means. Because I think whether it's today or that sometime in the future, there's going to be a day that this matters to you. The first thing I'll tell you, you need bigger down payments. These programs are not designed for 0 down or 5% down. It's 10% down or better for these programs, but they allow gift money for down payments. So our non-QM at Cross Country is significantly different than everybody else's. Everybody else just has what we call our Platinum program, which says, hey, the rules are what they are. And you got some flexibility, but you have to meet those rules. But we go 2 layers deeper. We have programs that I've never had access to through our expanded portfolio. Nobody has that portfolio loan. Well, John, what does that mean? It means that I can do loans even if you can't prove any income on a primary home, but you have assets. Because logically, if you have $1 million in your 401k and you want to borrow $500,000 from me, why should I worry about exactly how much money you bring in each month? You literally could pay off the mortgage twice if you liquidated your 401k. So logically, you should qualify for that mortgage. I now have the ability to use that kind of logic. So there's a lot of ways that we look at things different. And one of the biggest things we do is we look at the fact that we wrote the rules and we're lending our own money. So we make a lot of exceptions, like property that isn't unique property. Maybe it isn't a normal, how should I say, maybe it isn't your traditional single family home. Maybe there's some unique characteristics. Maybe it's a mixed use property that has some office space in it. Maybe the property zoning issues. Like there's lots of things that we might be able to look at. Now it's only for residential properties, but there's some characteristics like rural, large land, excessive acreage that we'll make exceptions on, because this level 2 and level 3, it's our money. Cross Country Mortgage, largest mortgage company in the nation. We're not a bank, but we have access to private funds. We wrote the rule book. We get to break the rules. It's like my dad when I was growing up, and he's like, hey, don't ask me whether I'm doing what I told you to do. I'm the dad. I make the rules. I decide who has to follow those rules. Well, that applies here. At Cross Country Mortgage, for these expanded programs, we make the rules. We decide how we get to break the rules. One of the most important examples I'm going to bring up as a simple example of how we break rules or how we look at things differently is the common sense of you owning a house today and wanting to sell that house to buy another one. But a lot of people don't want to sell first. They want to buy first so you don't have to worry about moving twice. You don't have to worry about the fact of, hey, I've sold my house and now there's nothing to buy and I'm homeless for a while. They want to buy, they want to get themselves moved into the new house and then sell the old house. The problem is, how do you afford to pay for 2 payments? Well, a lot of people have come to me for years and said, John, I literally have an extra $50,000 in the bank. I can pull money from that every single month to help make the payment. But the mortgage world says that's only temporary. You literally might not sell in 6 months or a year, and you might run out of that 50 grand. And then how do you make the payment? Like, then I'd lower the price. I would sell it. I'd rent it out. There's something I can do. It's not like I'm stuck carrying 2 mortgage payments forever. Our portfolio program understands that. Our portfolio program says, look, if you have extra money in the bank to help you cover the payments to get through, we're golden on ignoring that monthly payment. And I can even get you a bridge loan out of your old house to help you put the down payment on your new one. This is the type of common sense that has not existed in our industry, and we're now able to do it. So I wanted to share it with you today because I'm super, super excited. I've been learning more and more about these programs, and I want to make sure I share all of that with you guys too. So that is about it for what I wanted to cover today. I really appreciate you that joined me live. If you have any questions at all, please feel free to reach out. Hope you have a wonderful weekend, and we'll talk to you soon. Bye-bye.